market is in this digestion phase of saying, how do we value, I'm putting them all together for this comment, how do we value these going forward? While we do see this economic expansion, which really is just right in the center of what RSP gives you. I will say one thing, though, you can't get away from AI. I looked at the top holding. SanDisk actually is the #1 holding at 50 basis points, which is twice the average holding weighting of any of our stock in there. So we're still have AI anywhere we go.
Now, Weiss, it doesn't matter whether you think Yardeni's going to be right about 70K, but what he says about the mechanism to get the market higher from where it is now feels like it's right on the money. That the delivery side, as we said, the transports and Dow theory traditionally confirms where the economy looks to be, and the production side, industrials say that he says the market currently views the 2026 growth story as fundamentally solid. Hard to poke a lot of nails in that.
Yeah, I'd agree with that.
Poke a lot of holes in that, excuse me.
Yeah, and I don't really care about his targets, you point out. It's what's the direction. We can worry about targets later. So I think everything's in place for the direction. But here's what I find that's always so interesting in periods like this, which is that when markets correct significantly like we had, everybody says, oh, that's healthy. But when a market shoots up like it did on Friday and it shoots up again today, nobody's saying, well, that's unhealthy. So to me, what I'm getting at is that valuations right now are too high. So it would have been good to see the market base for a little bit.
When you say valuations are too high,
yeah.
Don't you need to be more specific when you say
Sure.
that rather than a blanket?
Exactly. So what I'm talking about is Microsoft's adjustment.
That's what Capital Econ says today as they look at the retail report. If you're bullish, you are like Steph and UBS, which suggests the backdrop's still really good. Resilient economic growth, the Fed's still supportive, don't hang on what the Cleveland Fed president is saying. It's just one person and one vote. And AI adoption is yet another reason to be bullish. So what do you make of all that?
Well, Steph is right, and Steph has been right. And, there's a whole cottage industry of people who want to nail the turn exactly as it happens. So they see a negative data point on the consumer, and they spin it up and extrapolate it into this whole thing that's just not based in reality. I know we're going to talk about the travel stocks later, but I'm sorry, Hilton and Marriott is not like me pointing at to the Four Seasons Hotel. So yeah, it's K-shaped, but honestly, people are not voluntarily crisscrossing the country on vacations if the consumer is cracking. It's just not the way reality works. So I know how badly people want that turn, and they want to be, see, I told you. But the thing is, you listen to the JP Morgan conference call, they issue everybody's credit cards. They see all the debit card spending, et cetera, and they almost have to apologize. Jeremy Barnum has to come on the call and say, guys, I know what you're all looking for. And once again, 12 straight quarters, it's not here. There is no sign of exploding credit card liabilities and past due this and auto loans being, payments being missed. We don't have it. I'm sorry. So until we do, how about we focus on exactly what Joe and Stephanie are talking about, the absurdly strong earnings picture. If you think about it, analysts are now expecting profits to grow 12.3% year over year. That is 386 basis points ahead of what the estimates were.
Growth is there. Once you start to disaggregate, it's not, it's not as good a picture.
What do you think? You warm enough over there?
I am. It's it's all about layers. Quite frankly, it is.
Everybody loves layers, though.
There's a lot of layers to this conversation already.
I'm a big red onion. Okay.
Haven't earnings? I mean, if Einhorn says, I think this is the most expensive market that we've been in, someone like Ed Yardeni would say, that may be true, but justifiably so. Look at where earnings are.
Yeah, I love Ed's comments. We can, not just because we agree, but we kind of come from the same vintage, and he's talking about some of the same things that. Yeah, we do.
No, you don't.
Go ahead.
Okay, just continue. We're in the process of transitioning in this fourth year of the bull market from a momentum, multiple-driven market to an earnings-driven market. When we wrote our year-ahead piece for 2026, we talked about traditionally and historically over the last 80 years when the S&P 500 moves into more of an earnings-driven market, the returns are roughly half what a momentum and multiple-driven market. Doesn't mean it's not going to be positive. It's still positive. That, to me, is a much more fundamentally driven market. And what's happening with the market and with the participants with these binary moves, buy, sell, there's a big disruption between short-term, intermediate-term, and long-term. And I think at the end of the day, what the market's showing you is that other areas of the market are working. Dividend growth, value, small cap. And the more that they work, the more credibility they have. The more credibility they have, the better performance. So performance begets performance, and we continue to think that those areas will continue to lead in this broadening out.
Barclays today upgrades value, downgrades momentum. Joe, you can go on that, and cautions on small caps. Like small caps got out of the gates like a Ferrari to start this year, and then that's obviously cooled a bit. There is the rates question.
We decided to add to our position last week.
Malcolm, you have no ownership in either the areas of transports and industrials. You just tell me why. Why are you avoiding that area?
I don't love old economy as much as these guys do. I completely understand the notion that AI can't disrupt an airplane out of the sky, can't disrupt earth-moving equipment at construction sites and things like that. But I think there's a ton of opportunities being created right now in the software space and the tech space that are probably being ignored. Some of them are old tech. And I think that's where the opportunities are that I'm more interested in than.
Carrie, got some exposure. Lynn, Wabtec, Waste Connections.
Yes, so I think it's important to have diversified your portfolio if you are heavily invested in tech and communication services, and we've said that for the last couple of years, even though it hasn't really worked. But let's remember that owning some of these industrials, and Wabtec, which has been a fantastic stock for us and had really strong earnings, is sort of suggesting that UNP, one of their big customers, might be pulling back a little bit on their capital spending this year. I mean, the stock has continued to go higher, but the risk with some of the old economy, such as Delta as an example, is that maybe they don't make money. They lose money. Maybe the stocks get very expensive, or people just sell them because they're extremely volatile stocks, and that has been true through history. You have to be careful about just moving out of growth and moving into.
I couldn't agree with you more. And a really great example this week was Coca-Cola. So we wrote it up for our best stocks in the market column at CNBC Pro on Monday, and we said, do not buy it. Yes, it's undisruptible. Yes, we understand that's why it got swept up in this wave of popularity. But at the time we wrote it up, it was an 85 RSI. So we said, let it cool off. Not that I predicted the earnings. The next day, they reported a good quarter. The stock fell 6%. That was your chance to reload. And now here you go, Coke back to making a new high. We can't just indiscriminately buy stocks because they're not disruptible, because let's remember, those aren't the only risks. Right. We have economic risk, right? We have consumer risk. We have risk no matter what stocks we buy. There is not a segment of the market that's not risky. We're talking specifically about disruption risk.
And Stephen Weiss. So we will check the markets. As Carl and Court were just telling you, we've had a nice little turnaround here. You can thank Goldman Sachs, which was down pretty heavily earlier. It's come back. JP Morgan, same story. Microsoft, Meta, Amazon, same story. That shows the Goldman move. We're going to get to all of that. The CPI, as you know, was cooler, but the biggest story out there remains how AI is just rippling through this market, sector by sector, day by day. We have a good wall to show you that sort of takes you through that in what Barclays determines to be a sell first, ask later market. No mercy for almost anything. There it is. Software, you know about that. Well, gaming, okay. Legal tech, insurance brokers, wealth managers, property managers, and freight off of that transports takedown yesterday, which was downright ugly. Weiss, take the first shot at this market, which, you know, maybe some people have looked at some of these areas that wall shows you, have gotten banged up and said, this is like, okay, a little crazy, a little ridiculous. Shoot first, ask later, but maybe you need to think about think about this before you?
Yeah, I don't even, they used to say don't see the whites of their eyes. Well, they're not even waiting to see the whites of their eyes. So they're shooting in advance of shooting first. So look, to me, I made this observation last week that when markets go down, people say, wow, that's really healthy. But when they rise up with the same force and same vigor, like Nasdaq up 400 and the Dow up 1,000, nobody blinks an eye and says, this is great, let me add to it. Well, to me, that's the inverse. That's troubling, and that's what we've seen, we'll continue to see. Now, what happens in that, when you see these go down, I do think you have to buy. However, I will tell you that I'm looking to sell some things. I won't sell them down here. And the only ones I'm really looking to buy are the ones where I can really justify the valuation, and I don't need to deal with, is AI going to put them out of business or significantly damage their business? And that question